In today's video, we're going to look at an example of a post-earnings volatility crush and using Netflix as the example. So a really good example came from 2013 when the stock closed down 4.4% after earnings, yet nearly all of the puts were absolutely crushed. So normally you'd expect the stock going down, you'd expect the puts to go up in value, but the puts actually went down in value. The reason for this is the volatility premium or uncertainty coming out of the option prices after earnings. Some traders call implied volatility the excitement factor, and during earnings there is a lot of excitement and fear regarding how the numbers will come out. As a result, implied volatility goes through the roof, resulting in inflated option prices. Generally, implied volatility will gradually rise into earnings and then get crushed straight after the announcement as the uncertainty is taken out of the market. You can see a great example of this on the next slide with Google. The gold line shows implied volatility gradually rising into each earnings announcement and then getting absolutely crushed after the announcement. So you can see that pretty clearly in the yellow line. Really good rise in implied volatility up to earnings and then just gets absolutely crushed afterwards. You can see the same thing happening with Netflix. And in this example, from mid to late July, implied volatility rose up to just below 80. So high 70s and then down into the low 40s after the earnings announcement. Each earnings cycle, there is a battle between market makers who have to price options and traders looking to profit from the volatility crush by selling, strangles, and straddles. Let's use a simple example and assume you have a stock trading at 100. The $100 calls are trading at $5 and the $100 puts are also trading at $5. This tells us that the market makers are expecting a 10% move in the stock post-earnings, $10 or 10% on a $100 stock. So with our Netflix example from 2013, Netflix was trading around $2.55. The at-the-money calls were trading for about $21, and the at-the-money puts were trading for around $15. If you combine the two, you can see that the market makers were predicting a move of $36, regardless of direction, or around 14%. So after earnings, the stock closed down only 4.4%, so much less than the expected 14% move. As you'd expect, the calls dropped in value, so they dropped from $21 down to $2.60, so they got absolutely crushed. But the puts also dropped in value, even though the stock was down. So the puts dropped to $7.50 from around $15. So a trader selling that $2.55 strangle before the earnings announcement would have made about $26 per spread. A pretty significant profit. So a resounding win for the short straddle trader over the market makers. Now it doesn't always work that way. Sometimes the move will be much greater than the expected move, in which case someone who sold the straddle would lose and the market makers who priced that straddle would win. So here you can see the example. Notice that even though the stock had a pretty big drop at 4.4%, that all the puts have dropped in value due to the volatility premium coming out of the prices. So you can see those calls have really dropped in value. They've dropped significantly. The puts have also dropped significantly in value, particularly those out of the money puts, but even the in the money and the at the money puts have dropped significantly. Trading options on individual stocks is risky, especially with volatile stocks like Netflix, but it's interesting to see these types of scenarios play out. If you look at Netflix over the last few years, you can see that they have had some massive post-earnings moves, so you can understand why the market makers were expecting a big move in this case. Hope you enjoyed this short tutorial today. If you want to learn more about how I trade and analyze the market, just check out my website, optionstradingiq.com. If you scroll down a little bit on the homepage, there are a couple of free courses for you. The Iron Condor course will take you through all the theory of how to trade iron condors, which was one of my primary strategies, as well as my full trading approach and other tips and tricks, including how to adjust. Same thing with the butterfly course, lots of good stuff in there, all free if you want to learn a bit more about butterfly spreads. So thanks for watching and I wish you good luck and good trading. If you have any questions, please leave a comment below and I'll be happy to answer those. If you've enjoyed this video, please hit the like button. It would be greatly appreciated. All right, talk to you soon, guys. Take care.